to this month's Global Market Overview by LOLC Securities. I'm Tarandu Amarasekara. Our focus will be on the conflict between US, Israel and Iran and the impact on the global markets. With the risk of a closure at the Strait of Hormuz and disruptions to the Iranian oil output supply, there are tensions and shocks towards global energy prices expected all over the world. The war has turned the Strait of Hormuz into a flashpoint, threatening a route that carries roughly a fifth of the world's oil and much of its gas supplies. Even talk of disruption has pushed oil and gas prices sharply higher, lifting fuel, transport, and electricity costs for households and businesses everywhere. That means central banks that were getting ready to cut interest rates may be forced to stay tougher for longer, raising the risk of a painful mix of high inflation and weak growth.
Equities have sold off while oil, gold, and dollars jumped as investors rotate into perceived safe havens. Their currencies tend to weaken against the dollar in such shocks, making imported energy and food even more expensive and adding another twist to the inflation spiral. Central banks from South Asia to Africa may be forced to choose between raising interest rates to defend their currencies or tolerating higher inflation and slower growth.
In terms of an economic impact, higher energy prices are expected to slow down the GDP growth of US, Europe and Asia, and some researchers have said that some of the economies which are vulnerable already might be tipped to go towards a recession. Higher energy and shipping bills are eroding profits and household spending power, threatening to shave off the US, Europe and major Asian economies' growth. Economists warn that if oil stays near above $100 a barrel for long, the world could gain flirt with stagflation, slow growth combined with stubbornly high prices. Policymakers now face a dilemma of supporting growth with easier money and risk more inflation, or stay tight and risk tipping vulnerable economies into the recession.
Energy importing countries in Asia and other emerging markets face worsening trade balances and weaker currencies against the dollar. This flight to safety is tightening financial conditions and pushing up borrowing costs for governments, companies, and home buyers at a delicate moment for the world economy. If the conflict drags on or widens, markets fear a deeper correction, fresh stress in credit markets, and a hit to an already fragile investor confidence.
Talking about the sectors most affected, tourism, shipping and airlines are the worst affected due to this crisis made due to the disruptions. However, some energy producers and commodity-linked firms are seeing short-term gains. Energy-intensive sectors like airlines, shipping, tourism and some manufacturers are being squeezed by higher fuel costs, rerouted sea lanes and rising insurance premiums. At the same time, oil and gas producers and some commodity-linked companies are enjoying a short-term windfall from higher prices, even though they worry about longer-term demand. For ordinary workers and consumers, this means more expensive air tickets, costlier goods on store shelves, and in some countries, renewed pressure for government subsidies. We hope you enjoyed this round of Global Market Update from LOLC Securities. Stay tuned for next month's update as well, where we bring you the latest from the world of business.